Well, that's just Prime, Goldman Sachs, Amazon Web Services, ANKR, and is that Optimus Prime? This episode did not begin with me making a thumbnail featuring Optimus Prime. And before you roll out, let me tell you a story that involves ANKR, a SPAC, $1 billion, a DAO, a talking milkshake, and the future of Web 3. This video began while researching ANKR's most recent partnership announcement. If you missed that, then let me bring you quickly up to speed. Partnerships are an important keystone to ANKR's future success, and I will be touching on that here in a moment. This idea of partnerships as anchoring ANKR across the Web3 ecosystem. But if you're new here, let me simplify. ANKR, well, ANKR is going to the moon and beyond. Longtime subscriber? Well, then you knew that already. Okay, and if you are new here, well, now you're up to speed. This episode started as I was crawling the comments section of Reddit, tipped off first by Die Crow on the Unusual Due Diligence channel about the recent Syscoin partnership. I took a little time to do some investigation, and that's when I learned something by way of a photo. I said to myself, quote, "Hey, wait a minute, I recognize those boxes. I modeled them in 3D, end quote. Today's Unusual Due Diligence truly begins with the screenshot shown on the screen. It's of a render that I did in Blender in 3 tantalizing dimensions of what I thought was an ANKR mining box. And so begins our adventure. Welcome to Unusual Due Diligence. I am your host, Poseidon, god of the sea, and whose spirit inhabits this milkshake. As an inanimate milkshake that spins stories, my job is to take us on a journey. And today I have one very interesting ride. A journey that will no doubt have me up way past my bedtime in order to get this fresh episode out the door. This ride, this journey, it is one that all started with me building a list. A list can be quite useful, and sometimes just building one list will bring about insights that you didn't even anticipate, and that's exactly what happened. Let me show you the specific comment I scrolled over on Reddit that started this adventure ride. The comment is on the screen now, found on Reddit, where Total Hour 5584 asked, quote, "Can someone make a picture of ANKR with all of its partnerships?" End quote. Since that question spoke to my inner soul and artist in a very deep and profound way, I decided I would attempt to make the picture, a picture showing all the relationships. Now, spoiler, this episode is not going to cover that picture in any detail. It does, however, take us to Optimus Prime. Well, the latter and not so much the former, meaning more Prime and less Optimus. Here's how that works. The spreadsheet I made to track and identify all of the public partnerships had 3 columns. The first column was simply the name of the partner, and the other 2 columns were going to be places for me to better illustrate my confidence in that partner by having links, emoji, or maybe some shorthand, reminding me to cover an existing ANKR partner on this channel. You see, I crawled through Voltron Supreme's channel, who does a great job, by the way, on these partners and their breaking news, and then went to Google and began searching for every partnership I could find or tease out from ANKR. As I went about the process, I just started taking notes. That led to the creation of this list shown on the screen, and it's a fascinating list, but it's really where the story goes that just kind of blew my own lid because today I'm in the form of a milkshake. Okay, bad jokes aside, let me briefly read off the names of the potential partners that I identified in my searching. They're up on the screen so you can DYOR. Sacramento Kings, MaxiHost, Portal, Matic Network, Standard Protocol, Marlin, Bitfrost, DIA, Meteor.io, Bakery Swap, Chili's, Troy, Nervous Network, Harmony, Byte Labs, Arweave, SAP, LTO Network, Linux Foundation, 1031 Bank. Okay. That's the list, and wow, what a list. And one I see I have a lot of work ahead of me to pull apart. ANKR is doing a whole lot. What is incredible about this is that, well, pause that thought for a moment. Do you see 1031 here? There's an arrow on the screen pointing at it. 1031 caught my attention. It seemed a little, well, unusual from the perspective that I've never heard of it. And I'd like to ensure I'm not passing along low value information in these videos. The reason is pretty selfish. I've just found if I share lower value information, my videos don't do as well. I mean, it's hard to argue with that insight. Make better connections and content in the channel videos. Well, it's a mystery of the universe, but the videos perform better in terms of likes, comments, or subscribers. Cool stuff. I make amazing content, build the channel up, and ride with everyone to the moon. Win-win. So, am I sleuthing up what this 1031 company might be about, and if it was a good search result or a bad one? And I discovered in the process a real doozy of a press release that at first I thought was just an April Fool's prank. That is, until I dove deeper into the sea, and in that press release, into a little bit more detail, I found a linked site and verified those fundamental details with the SEC of all places. And it's at this point Optimus Prime is about to enter our conversation. So, what's going on exactly? It begins, well, all of this craziness begins with this video whose thumbnail I have on the screen, which is one of my first videos on the channel. And where has the time gone? That was 6 months ago? You know, I just wanted to make fun videos of stuff I just like thinking and talking about. And 6 months later, here we are, me with a milkshake explaining all the inner workings of the cryptocurrency markets. You could say I didn't see that coming. So if you haven't seen that video, it's just me going over the speculation about something called an ANKR Mining Solutions. I would later explain that from ANKR's perspective, this is largely a distraction from the royal work that ANKR is doing, and an unnecessary burden on their team to ask them about that. This video situates in my head that disconnect. If you review my overall playlist in ANKR Mining Solutions, then you can see my explanation of, well, what I found. And even better, I took time to model some of those metal ANKR mining boxes to kind of internalize what it was that they were up to. Coincidentally, that first ANKR video that I did on this channel is what got me thinking that I needed to embark on an ongoing and never-ending expansion of ANKR tokens that continues to this day. And it's a collection I've since learned many of the people that find their way to this channel also happen to do. And in a way, this video serves as a milestone. Not only was I right about many of those key details, but it turns out the future has the moon an even better view than I could have ever predicted. You should be aware that as God of the Sea and Talking Milkshake, I am not a financial advisor, but I did buy more ANKR as a result of what I'm about to share with you. This episode is a little bit more complex than most, and so I will build a map today. I'll timecode this video into chapters. You can jump around as you need to. That'll be your map. Those timecodes will be in the description below. Let's begin. ANKR's evolution is hinted at in the Syscoin partnership. The snippet reads from the press release, quote, ANKR will also incentivize Syscoin node operators. You will be able to contribute your node's resources to support RPC service and receive ANKR tokens in return. This creates a path to an incredibly resilient and decentralized RPC network. It's also a great option for those who would like to contribute to Syscoin infrastructure without having to collateralize 100,000 Sys to operate a master node, end quote. Did you catch it? Receive ANKR tokens for those who don't have 100,000 to operate a master node. I won't cover what this means for Syscoin, not today, because today I want to paint a broader and more holistic picture of ANKR. I will say this, what this means on one level is that ANKR is allowing participants who can't meet the capital intensive requirements to still participate. Notice the reward for joining Syscoin nodes to the RPC network is ANKR tokens. Take a moment to simplify down this model. ANKR tokens for hardware as an offset to capital requirements of being a full node provider. Today's due diligence has a couple key assumptions. One, that the current executives behind ANKR and large ANKR whale holders are as motivated to build Web3 as they are to amass profit. Two, the reason why there exists a profit motivation is a psychological blend of personal gain and the drive to complete the vision. Money is just digits in a bank account, but changing the world in a fundamental way because of those digits is highly addictive. 3. Original ANKR holders, the original whales, would be drawn to building and completing projects that they would believe to moon their existing ANKR holdings because of the principle of loss aversion. This means no one likes losing their resources. It's a human condition that's shared by the majority. It takes a lot of inner focus to overcome loss aversion. Given these three ideas then, what are some things you could do as an original whale of ANKR to increase the value of your holdings with an eye to change the world? Well, you could thread ANKR into as many partnerships that you could get your hands on. The more partnerships, the more the floor of ANKR gets set into place. Suddenly, ANKR becomes less a follower of the big orbit of, say, Ethereum or Bitcoin, and moves according to usage and demand of Web3 and DeFi itself. And this, incidentally, is a lesson I'm jotting down for the UnDD'er token. How could I couple the UnDD'er token in partnership with some other cryptocurrency project to make it even more meaningful? What are mechanisms for me to do that? Tough questions for sure, but it's a grand idea. And this idea of partnerships, it sounds pretty good. And there's also something else you could do. And it comes down to a specific problem in crypto, and it's operating at scale. The original ANKR vision was founded on the idea of converting excess capacity into economic value. ANKR unlocks all the dormant economic value in a data center. So, what if you built even more of them, more data centers? That is, what if you took the idea of managing excess capacity one step further and began building out your own hardware and infrastructure? And this, on the surface, seems like a pretty good idea, except there is a catch. The capital inputs into building out data center operations are very high. There's three key inputs: contracts, cash, energy, labor, and commodity material like metals, wood, boxes, and wires that make it all work. That's way more than 3. You could conceptually bootstrap a few of these, meaning pay out of your own pocket. But to achieve self-sufficiency, well, then you're going to need cash, and a lot of it. Unlike other cloud providers, in ANKR, the economics of idle compute is now a solved problem, and there's crazy amounts of demand. Even better, you know as someone with a large ANKR holding, that if you could just build out a large enough run of data centers, you'd not only send your ANKR token holdings to the moon at light speed, but you'd simultaneously solve the problem of centralization of cloud infrastructure, such as with Amazon. You could become that which ANKR holders have predicted, the AWS of the Web 3.0 era. Coincidentally, this even surfaces in a recent media story as people are waking up to a new world in 2022. So you see, ANKR's price would ebb and flow, but then eventually go to numbers that until now have only been predicted by many to exceed upwards of, well, now I'm just getting ahead of myself. After all, to build these mining operations for cryptocurrency, you'd realize pretty quick, into your project, the only way to make this work is access to the capital markets beyond crypto. This means you need someone to help bring the secret little ANKR project into the light. How? The answer is with an investment banker, a SPAC, and a whole lot of money. Billion plus kind of dollars kind of money. May the SPAC be with you. The SPAC is the current way that companies go public on the exchanges. Unfortunately, access to capital markets does come at a cost. I feel like an authority on this because I had a SPAC investment last year for a certain AI-based Medicare company I won't name, and they sprung a surprise share offering that completely undermined my portfolio. After making a mess of that, I did what any reasonable person would do, and that's buy some action figures and then spend the rest of the year posting online videos about cryptocurrency. To understand both the positive and negative about SPAC performance and how it impacts us in the future, we need to level set a couple key specifics. First, let me tell you what a SPAC is briefly. Special Purpose Acquisition Company. A Special Purpose Acquisition Company, or SPAC, is a publicly traded company created for the purpose of acquiring or merging with an existing company. Okay, Poseidon, you might ask, why do SPACs exist? Well, they exist to tease me with untold gains. But also, the entire Special Purpose Acquisition Company, that's SPAC, exists to solve a specific kind of problem. The problem is that an upstart needs capital to scale. Lots of capital. It can be hard to appreciate the kind of capital required to scale a business these days, but when you start factoring labor, inflation, and specialized contractors to securing deals, it's all very costly. I rather like this explanation of a SPAC and why companies even pursue it. Quote, a SPAC, or Special Purpose Acquisition Company, is another name for a, quote, blank check company, end quote, meaning an entity with no commercial operations that completes an initial public offering, or IPO. After becoming a public company, the SPAC then acquires or usually merges with an existing private company, taking it public. Before completing a merger acquisition, many SPACs provide no indication to investors about the type of company they plan to merge with or buy. In effect, the special purpose of a SPAC is to bring a promising private company to the public investment market. Although SPAC strategies can be complicated, they tend to take less time to complete than traditional IPO listings and can be cheaper. The advisory fees associated with going public via SPAC tend to be far lower than the fees charged for a traditional IPO. Early stage companies can more easily comply with the requirements to merge with a SPAC than they can successfully complete an IPO, end quote. On the surface, this sounds fantastic. Except there's a pretty big problem. The problem is that investment bankers make their money on bringing companies through the IPO process. So if there's no IPO, then the investment bank doesn't get their cut. This is a bit of a problem. You see, one of the publicly secret duties of a CEO of any publicly traded company is a less than glamorous one. The CEO puts a silly amount of time into working deals with investment houses, banks, funds, and so on to put, quote, whale-sized, end quote, money into a company by buying either a restricted or non-restricted offering. Here's why I say that, and I have a very specific reason for explaining this that will be made more clear in a moment. When an investment bank or fund misses out on the IPO of a SPAC, the SPAC, when it achieves the evolved form, takes on a new risk character for a financial operating year. That's because the underlying security is, for better or for worse, already established in some ways, and so has to, quote, follow the process, end quote, within the institutional fund or a bank. The popular notion is that investment houses, funds, and banks all hate SPACs because the SPAC didn't participate in the IPO process, and so the bank or fund didn't get their cut. That's not quite right. Funds like money, but they also have a fiduciary responsibility to manage risk. A SPAC sits on a different risk register. What does this mean? Well, it means during the first operating year of a SPAC, the most likely direction of the price is down. And you can check out SPAC performance to confirm this. The first operating quarter might even be up in the short term, but in the longer term, over the operating year of the company in that first year, the most probable direction of the price is down. And it's not just because the SPAC is missing out on whale investors who are sizing up the risk of player 2 that has entered the field to play. No, you see, it's also a function of the reason why the company entered the SPAC in the first place. That reason, access to capital markets and a real need to raise money. And that either means selling authorized shares or using funds raised to offset capital costs such as corporate bonds or other loan products. Now, here's where the story gets very interesting. How would you run a SPAC that minimizes the downside effect of a SPAC merger that brings a privately bootstrapped company public in order to get access to capital markets, in order to comprehensively build out a capital-intensive operation? What's like the smartest possible move you can make here? You could run the company yourself, but remember, I said the first job of CEO is to ensure institutions are buying into your SPAC, and as you need cash and connections to get deals done. So, how do you solve that? Well, I can describe 3 pieces of an ideal solution. First, you'd want someone that was connected to investment houses. Even better if they had some big bank or fund experience. That'd cement legitimacy of the SPAC. And then you'd want someone that has experience specifically in energy and the capital markets, because you're going to need infrastructure, big infrastructure, and need someone that knows how to play that game. It's not a clean game, but it's a game that needs to be played. You need someone that has experience with a firm that has a track record of doing what's required to move the needle. Third, you'd want someone that has established relationships, not just in the infrastructure and energy markets, but also with media credibility that has enough real-world international experience to make everything click into place. Why do you need all this? Because you are bringing Web3 and blockchain, or DeFi, to a global scale. You're going to need more than just a few $100 million to scale that. Okay, it's at this specific juncture I need to go back and explain the 3D render that caught my attention for a company called PrimeBlock. If you look at my render, it's a very specific kind of design. There's a kind of aesthetic here, a form meets function, which is why when I show you this screenshot from the website of PrimeBlock, you can imagine my first thought, quote, "That's exactly the same as those ANKR Mining boxes I modeled a few months ago. Huh," end quote. And that all happened because of this press release I stumbled on during April 1st, announcing the SPAC move of a project called PrimeBlock. The summary from the press release has what I thought was just an April Fool's deal, but it turns out that no, it's legit. Quote, "A combination of PrimeBlock and 10x Capital Venture Acquisition Corp. 2 to advance PrimeBlock's focus on the blockchain ecosystem." In Q4 of 2021, PrimeBlock generated $24.4 million of revenue and has over 110 megawatts of installed data center capacity. A business combination based on enterprise value of approximately $1.25 billion, led by CEO Gaurav Virani, a former Goldman Sachs investment banker. Veteran who advised on over $300 billion in crypto, technology, and natural resource transactions. Co-founded by Web3 entrepreneurs Ryan Feng and Chandler Song, who founded a leading blockchain infrastructure and developer platform. PrimeBlock has secured a $300 million committed equity financing facility from Cantor Fitzgerald affiliate. Merger is expected to be complete by the second half of 2022. The combined company expected to be listed on NASDAQ, end quote. PrimeBlock. I do wonder if that's an Amazon PrimeBlock, meaning a subtle jab that the intent is to conquer Amazon Web Services, a kind of Web3 sunscreen, prevent Amazon from owning the world. You see, PrimeBlock, co-founded by Ryan Feng and Chandler Song, is being led by Budrani, the former head of the cryptocurrency desk at Goldman Sachs. It's time to sit up and pay attention, friends. Are your ANKR bags topped off? Having Goldman Sachs' executive presence lead this initiative is why Ryan Feng and Chandler Song are geniuses. They set aside their ego to pull in a rather interesting selection. The CEO for this PrimeBlock project is an investment banker with software experience who was the vice president of the crypto division within Goldman Sachs. Even crazier, this same individual worked as an analyst in energy markets. I'm fully convinced that when this former VP of Goldman Sachs saw this ANKR-inspired opportunity, he saw the future, which is why he's now CEO of PrimeBlock. And as ANKR holders, it's noteworthy that Goldman Sachs crypto division has us under close watch. Probably means also this channel, and I'm not sure how to feel about that, but then I am a milkshake and got into the sea, so it doesn't really surprise me at all. Taken together, this all sounds great for PrimeBlock, but what's it have to do with ANKR? Well, if you think PrimeBlock's founding members of Ryan Feng and Chandler Song aren't enough to demonstrate that PrimeBlock won't pull in ANKR, what if I told you there might be other ANKR members that are also coming over? Consider the case on the screen. And knowing that PrimeBlock is operating in the same cities that ANKR was on the down low, hiring for specific jobs for data center technicians, I think it's safe to say that ANKR is literally in the DNA of the PrimeBlock company. Imagine ANKR threaded in our first publicly traded corporate deal, and the next step, even more corporate deals for ANKR. Now at this point, the hopium needle overflows, but there's even more to pump into the veins. How do you protect the ANKR token, which has a vibrant community of leading minds like this channel out in the wild extolling the virtues and benefits of this ANKR project? Well, you want to ensure that you have the hardware side covered, but then you want to divorce the ANKR project from the mainstream markets and, in a way, set it free. How do you do that? Well, the answer is you put ANKR into a self-running DAO, or Decentralized Autonomous Organization, in order to maintain the lifeblood of your company as connected to all the best of the decentralized world, while at the same time getting a toehold into the very real economics world that's going to allow you to build up a platform to compete with the likes of Amazon Web Services, which, hey, taking on a $1 trillion company is going to take some real money. A DAO or DAO would mean the token behind the project creates an economic miracle on top of the crypto operations, enriching the balance sheet and fundamental economic value of the project. And if you're unaware, this is precisely where ANKR seems to be going. Gottman, Chief Marketing at ANKR, said that Alchemy is looking to be acquired by Microsoft. The ANKR team's plan entails moving parts of the operation into a decentralized autonomous organization, DAO, over time. End quote. Parts of the operation. Curious. It feels like this story is just beginning. That's because it is. This is Unusual Due Diligence. I am your host, Poseidon, and in today's episode, it showed the invisible line in the sand that separates ANKR from PrimeBlock, and how some very, very interesting things are in store for the ANKR community over the next year or two. In this case, the banker went to ANKR. So now I'm wondering when ANKR makes us the bankers. There's more to come from this milkshake, that much I do know, and an unusual future awaits. Make waves, my friends.